Investors typically look towards commodities as a way to potentially gain an enhanced portfolio diversification, as a way to hedge against inflation, and a unique source of return. Commodities as an asset class tend to have much lower to negative correlation with other traditional asset classes like equities and fixed income, owing to which they tend to provide a much better portfolio diversification. The most interesting observation, especially given the current times we are in, commodities have traditionally been known to be a very important driver of inflation. They tend to act as a better hedge not only towards rising expected inflation, but also unexpected inflation. We've observed that super cycles tend to coincide with periods of urbanization and industrialization, where the supply of commodities just fails to keep up with the strong growth in demand. The last super cycle that we observed was back in 2001, when China joined the World Trade Organization. That really helped turbocharge the development as barriers to commerce were removed. Investors are now questioning whether we're on the cusp of another commodity supercycle. We believe the energy transition, alongside a rebound in infrastructure spending, are important underpinnings in the commodity supercycle over the coming years. If we take the energy transition into consideration, investors fail to understand the incremental demand that will be required for commodities such as lithium, cobalt, copper, nickel, and aluminium. This is not only in the battery technology solution, but also in the electric vehicles that will be used to power ahead with the energy transition. A rebound in infrastructure spending will also require incremental demand from important industrial metals such as copper, aluminium, and zinc, which we think will rebound in demand as we see a global rebound in infrastructure spending.
Gold as an investment has been around for millennia and is arguably older than bond and equity markets. However, through the centuries, access to gold has changed. Today, there are probably more ways of accessing gold than ever before. WisdomTree created the world's first gold exchange traded product, and in doing so, democratized access to the asset class. Accessing a gold investment through physical exposure is very attractive, largely because the cost of vaulting gold is relatively low compared to the value of the gold itself. Futures markets in gold are quite attractive as well, especially for the shorter term trades. However, we do tend to find that most clients like the physically backed exchange traded product. It avoids having any of the roll costs included, and therefore, historically, physically backed gold exchange traded products have outperformed the synthetic. We have a broad range of exchange traded products in gold, and we keep innovating to keep abreast of client needs. For example, we created a product that only allocates to gold bars that have been created after 2019. 2019 is an important year because that's the year in which the London Bullion Metals Association embedded into their responsible sourcing criteria some environmental, social, and governance criteria. We've developed our own quantitative model for describing gold price behavior. In contrast to many market pundits who focus on univariate, our model is multivariate and therefore looks at many different factors that describe gold price at one point in time. Our model indicates that gold operates more like a pseudo-currency than a regular commodity. Interest rates, bond yields, exchange rates, and inflation are things that tend to drive gold prices more. Now, gold can be a defensive asset at times, but also gold tends to perform well in times of economic growth that is coupled with inflation. Our model framework allows us to develop a gold price forecast that is consistent with our macroeconomic view of the world. And indeed, we can play around with many different scenarios, alternative states of the world, where inflation, interest rates, etc. don't move necessarily according to our base case forecast, but alternative scenarios.